off would shrink the portfolio and return it to a composition of all Treasury securities more quickly. FOMC participants broadly agree that sales of agency-related securities should eventually be used as part of the strategy to normalize the portfolio. Such sales will be implemented in accordance with a framework communicated well in advance and will be conducted at a gradual pace. Because changes in the size and composition of the portfolio could affect financial conditions, however, any decisions regarding the commencement or pace of asset sales will be made in light of the committee's evaluation of the outlook for employment and inflation. As I noted earlier, the FOMC continues to anticipate that economic conditions are likely to warrant exceptionally low levels of the federal funds rate for an extended period. At some point, however, the committee will need to begin to remove monetary policy accommodation to prevent the buildup of inflationary pressures. When that time comes, the Federal Reserve will act to increase short-term interest rates by raising the interest rate it pays on reserve balances that depository institutions hold at Federal Reserve banks. To tighten the linkage between the interest rate paid on reserves and other short-term market interest rates, the Federal Reserve may also drain reserves from the banking system. Two tools for draining reserves from the system are being developed and tested and will be ready when needed. First, the Federal Reserve is putting in place the capacity to conduct large reverse repurchase agreements with an expanded set of counterparties. Second, the Federal Reserve has tested a term deposit facility under which instruments similar to certificates of deposit could be auctioned to depository institutions. Of course, even as the Federal Reserve continues prudent planning for the ultimate withdrawal of extraordinary monetary policy accommodation, we also recognize that the economic outlook remains unusually uncertain. We will continue to carefully assess ongoing financial and economic developments, and we remain prepared to take further policy actions as needed to foster a return to full utilization of our nation's productive potential in a context of price stability. Last week, the Congress passed landmark legislation to reform the financial system and financial regulation, and the President signed the bill into law this morning. That legislation represents significant progress towards reducing the likelihood of future financial crises and strengthening the capacity of financial regulators to respond to risks that may emerge. Importantly, the legislation encourages an approach to supervision designed to foster the stability of the financial system as a whole, as well as the safety and soundness of individual institutions. Within the Federal Reserve, we have already taken steps to strengthen our analysis and supervision of the financial system and systemically important financial firms in ways consistent with the new legislation. In particular, making full use of the Federal Reserve's broad expertise in economics, financial markets, payment systems, and bank supervision, we have significantly changed our supervisory framework to improve our consolidated supervision of large, complex bank holding companies, and we are enhancing the tools we use to monitor the financial sector and to identify potential systemic risks. In addition, the briefings prepared for meetings of the FOMC are now providing increased coverage and analysis of potential risks to the financial system, thus supporting the Federal Reserve's ability to make effective monetary policy and to enhance financial stability. Much work remains to be done, both to implement through regulation the extensive provisions of the new legislation and to develop the macroprudential approach called for by the Congress. However, I believe that the legislation, together with stronger regulatory standards for bank capital and liquidity now being developed, will place our financial system on a sounder foundation and minimize the risk of a repetition of the devastating events of the past 3 years. Thank you, Mr. Chairman. I'd be pleased to respond to your questions.
Well, thank you very much. And what I'll do is I'll ask the clerk to let's try 7 minutes around, and I won't be banging down the gavel too hard, but if people try and keep them in that time frame, it'll be helpful since we got a pretty good turnout, if we can. Let me begin, raise the issue. Senator Shelby noted the reference to the recent crisis in Europe. But let me start out there if I can. As the European Union announced its financial stabilization program in May, you briefed us.
Well, I can't talk about it right now, but if you call back in about a half an hour, we can.
Okay. A half hour, so right at 3 sounds good?
Yes, that would be fine.
Great. Thank you.
Identified a need to protect the American economy from events in Europe. With continued downgrades of European sovereigns, I noticed Ireland just the other day, they downgraded a bit. European bank stress test results expected this week. And again, there's been a lot written about that in the but how successful they may be, and the uncertainty about future economic growth as well. What challenges lie ahead, in your view, for the efforts you and your counterparts in Europe have made to stabilize the financial system?
Well, Senator, as I mentioned, concerns about the European situation created some problems in financial markets this spring, which spilled over into our own financial markets as well. The Europeans have been quite aggressive in addressing these problems. As you know, they, together with the IMF, have provided a financial program for Greece, and they have collectively developed a stabilization fund of 500 billion euros, together with additional funds potentially from the IMF, to be used to ensure that countries under